folks, here today I got a pretty fun video for you guys. We're going to get into 21 stocks on my watch list, 21 new stocks that I could potentially be buying here over the coming months. Now, first off, in order to get on my watch list, your stock already usually has to be a pretty attractive valuation. I don't keep track of just a million different stocks and things like that, although I might track those on a longer range or something like that. To get on this specific watch list I'm sharing with you here today, you have to already be at a price that I think is pretty attractive for somebody like myself that's a long-term shareholder, is thinking out 3 to 5 years into the future. Your stock price already has to be attractive. Otherwise, you're not getting on this specific watch list I'm sharing with you guys here today. And I will say all 21 of these stocks are potential buys for me at some point in the next, let's call it 6 to 9 months. It doesn't mean I'm absolutely going to buy them, but they're on this specific watch list for a reason. And probably because I'm very interested in buying these. A lot of what it comes down to is, are there other stocks that I already hold that are significantly damaged that I want to put money in more than these other particular stocks? And then do these ones get more damaged, for instance, okay? Now, in terms of these stocks, I'm not going to go super in depth with them because it's 21 stocks. So I'm just going to give you kind of a brief overview of what the companies do, why they're on this specific watch list, what excites me about them, and then we'll kind of move on because otherwise this video will be like 6 hours long. So yeah, I hope you guys enjoyed as always. Thanks for joining me. So don't forget to smash, especially if you enjoy videos like this where I share stocks, especially new stocks that I'm potentially going to buy down the road and could become big positions for me, okay? First one up here is Shopify. So Shopify, recently the stock's been devastated, guys. I mean, this stock was $1,700 plus. $1,700 plus was the stock in November. And since then, it's been devastated, and now it's a $600 and some change stock. Now, let's be very, very clear. If you pull all these stocks, I got them on a 5-year chart, although some of these companies have went public in the last 5 years. All these stocks, some of them have done horrible over the past 5 years. Some of them have done amazing. Shopify is one of those that its stock's done amazing over the last 5 years. Yeah, it's done awful since November, but let's be very clear. Shopify's done a great job of running their business over the last few years, okay? And if you think about this for just a moment. Who are the two main companies in the entire world when it comes to e-commerce? Well, not in the entire world. Let's exclude China, okay? Let's talk about North America, Europe, and other developed markets. The two most important companies in the world. One, Amazon. All right, and that might be one of these 21 stocks as well. Number two, Shopify. But the difference between Amazon and Shopify is, Shopify has come out of nowhere. This was a $6 billion market cap, if we go back 5 years ago. Shopify came out of nowhere, and they went in a matter of a 5-year span from just being some little company that's like, oh, they're kind of on the come up, to, wow, this is like a giant corporation that's going to become much, much bigger in the future. And if I think about the type of companies that have that type of potential trillion-dollar type opportunity in front of themselves over the next 10 years, Shopify is one of those sorts of companies. So the problem with Shopify is it trades really rich. And this is something that Amazon always had a problem with as well. It always traded really rich on price to sales metrics and forward Ps and trailing 12-month Ps. The same exact thing is happening for Shopify now, where it's like, yeah, man, their opportunity is so big. They got exciting growth. What I'm looking for Shopify is I expect them to have a pretty bad next quarter or two. And for many various reasons where, just e-commerce probably slowing down a little bit. And not only that, but if some of the Facebook changes in terms of iOS and what Google did as well is hurting that. And a lot of Shopify stores rely on Facebook advertising, Instagram advertising, things like that. That's going to likely hurt Shopify. So I think they're going to be in not the best place with their business model for the next 1 to 2 quarters. But after that, I think they're going to be getting back to kind of that excitement again and, the major growth rate. So right now I'm just kind of watching it. I'm just kind of seeing how this plays out. Outside of the market coming back massively, Shopify is going to be in kind of a floundering situation where the stock's just going to kind of move around in the, let's say, 450 to maybe 750 range for the next few months. Now, if the market comes back strong, Shopify is going to double up in a snap of fingers. That's the thing. But in order to do that, the NASDAQ pretty much has to go back to all-time highs. If that happens, for Shop to go back to $1,000, $1,200 in a snap of fingers, it'll likely happen. I'm kind of hoping that doesn't happen because I would love to build Shopify into a big position here. But that's number one of 21 that I'm keeping track of here. Number two, Purple. There's a mattress and bedding company. And this stock, it's went public in the past few years. And they had this kind of boom cycle for the stock price and kind of the business model and excitement and things like that. And ever since then, it's just been kind of down and out. $7 stock, American company, quality products, good brand, strong brand. And I like this one. It's gotten to attractive valuation ranges for me now, not a, company that'll likely make money in 22 from the bottom line perspective. But, over time, I think this will be a positive net income company, likely within a year. And also, the price to sales metrics and those sorts of things have gotten pretty darn attractive on this one. So I really like purple. Number 3 of 21, FUBO TV. The tough thing about FUBO, it's $7 here a day, okay? But the tough thing for me with FUBO is, man, I really don't know when the heck they're going to be profitable. I'll just be honest with you. I don't know. And so that's the thing. I look at this company. I'm like, it's $7. Their growth is tremendous. Big long-term opportunity. Looks like a very attractive company for another company to buy out, a Disney or somebody like that. I think, with Disney owning ESPN, I think this would be a great fit for them. But gosh, man, I don't know if that business model ever gets profitable. And if it does, it's so many years in the future. So that's a tough thing with me for this one is I'm like, it's $7. And is this a type of stock that could easily climb to $20, $30, $40 over the coming years? Absolutely. But that profitability, when do they flip? And I've looked so much into this company. I'm like, it's definitely not this year, 22. I've looked at 23. I'm like, it's not happening in 23 either. I'm trying to think about 24 and I'm like, I still don't know. And so if I buy a company that is not profitable, I like it to be a company that's going to flip within the next 1 to 2 years. I've got to feel confident that company is going to flip to profitability within the next 1 to 2 years. If I'm not confident in that, it's very hard for me to say I'm going to go buy this stock. And for FUBO, yeah, it's on my watch list, and man, it's looking like a snack. But the more I think about it, the more I'm like, I don't think I'll be able to make a move because as of today, at least, I cannot say in the next 1 to 2 years they're going to be profitable. And that's just a big difference between me and a lot of companies. If I buy unprofitable companies, I've got to feel confident that next 1 to 2 years they're flipping. FUBO, I don't know about that, man. So that's the toughest thing for me right now with that particular stock. Number 4 of 21, GOODRX. This company basically saves you money on prescriptions and things like that. All right. Now, this is a company that should be very, very profitable over the coming years. Big market cap in the past, market cap come way down. Big price to sales ratio in the past, a 40 plus price to sales ratio has come down massively for this company. This is actually I think a pretty attractive company business model wise. They don't have a ton of competition. There's a lot of talk that Amazon's going to get more into the space over time. That's what's honestly hurt this stock price in the short term. I'm going to try to, the thing with Amazon is every single time they ever do anything, everybody gets super scared. Oh, they're coming after this industry. Well, this company's done, right? And this even happened with big companies. So for instance, some years back that it was like, oh, Amazon's getting more into the prescription game, and Walgreens and CVS stock fell big on that. And so far that came out years ago, and so far it hasn't been much of a threat at all. If you think about it, just a few years ago, it was probably 3 years ago now, 4 years ago, FedEx and UPS stock got hit very, very hard because it was like Amazon's going to take, transportation of products more and more serious. And so UPS and FedEx stock fell hard. But yeah, Amazon's getting in that space and they're doing a good job, but at the same time, like UPS and FedEx have been thriving as well. So just because Amazon gets in a space doesn't mean like all these other companies are devastated or something like that. So GOODRX is kind of dealing with that sort of situation right now. But it's one I'm absolutely tracking, and it could be one I potentially buy. Number 5 of 21, Square stock. This one's had a tremendous past 5 years. Look at the stock price up 700+%, and that's even after this massive fall from 300 plus back in 2021, right? $230 something here today. But when it comes to Square stock, the reason this stock has climbed so much and had a tremendous 5 year is because Cash App. The Cash App is something that was launched by Square in 2013. Wall Street didn't really understand it. Like what's the big deal with this? And Cash App ended up becoming the number 1 most popular financial app in the entire United States of America. Like, go to your iOS store right now, type in, Cash App. Check it out. It's the number 1 most popular financial related app on the entire iOS store. Like, that is crazy big, right? Number 2 is usually Venmo or PayPal, and number 3 is either PayPal or Venmo, essentially, right? And so that's why this company has gotten such a big valuation on it over time, right? But when I look at Square, I see a company that's just an innovator and somebody that's going to likely be a big player in blockchain technology and crypto as well over time. And as those industries continue to take off over the next 5-10 years, I think Square is going to benefit with that. I don't think they're the only company. I think PayPal will as well. But yeah, I'm keeping track of Square. The biggest thing for me with Square is I've been buying PayPal recently, and like Square and PayPal I think are both very, very attractive, but it's like, where do I put my money? And so right now it's been PayPal. It could be Square over time as well. Maybe I end up buying both and just getting kind of the best of both worlds, and then I would own the two companies that control the top 3 most popular finance apps in all of the developed world, which is pretty insane to think about. Number 6 of 21, Lemonade. All right. This one is, for me, is just like the FUBO situation, where I'm looking at this company and the stock price is a joke here today, right? It's down so much, it's insane over just the past year or so. I mean, this used to be $100 plus stock, right? But when I look at Lemonade and I look at the stock at 20-something dollars a share, and even recently it was under $20 a share, I don't know when they're going to be profitable, and that's the hardest thing for me. And obviously the insurance space is very, very competitive. I think we all know that. But Lemonade, I think, is going to continue to grow, and I think they're going to grow much faster than any other insurance company out there in the world. But when is this business model profitable? From all the research I've done, I can't say. I know they're not profitable this year in 22. No way. Next year? No. 24? Probably not as well. So this is the same situation I'm having with like a FUBO, where I'm like, yeah, that stock price is devastated, right? It's, since this company went public, the stock price is down like 62%. It's down like 80% since its, highs of 2021. And I think I love the business model. I love the CEO of the company. I love their vision for the future. But gosh, I don't think I'm going to be able to pull the trigger on this one. I'm keeping track of it, but I'm like, until I feel confident on when they'll be profitable, I just can't make a move on a stock like that. And that's the hardest thing for me with this one and FUBO as well. And I wouldn't be surprised if they go on some big runs over the coming years, but I might not be part of it just for the mere fact that I don't know, man. I don't know when they'll ever be profitable. Teledoc. So this is one that I look at, and I am pretty confident that they will be profitable in 2024. And when I say pretty confident, I'm like 85% confident they will be profitable in 2024 based upon the numbers I ran. But what I will say is that's 2024 seems like a long time away, right? I mean, we're talking about over 2 years into the future. So this is what I'm looking at, and I'm like, it's almost in my kind of wheelhouse now, Teledoc, when it comes to like, I like to buy a stock 1 to 2 years before they're about to turn profitable, but I'm looking at it and I'm like, they're still about 2 years or maybe 2 to 3 years away from profitability in my opinion. So this is what I'm looking at. I'm like, am I going to get in this one? I would love to get in it from the perspective of not just they have a massive long-term opportunity and the stock's been devastated, right? But when I think about this, I don't own anything healthcare related right now. Nothing. I own nothing healthcare related. I got to own something, and I think virtual healthcare is going to become a much bigger thing in the future, and I think Teledoc's the number 1 player in that market and will continue to be. And so for that reason, it's a stock I'm strongly considering buying soon. That's why it's on this watch list. SoFi, number 8 of 21 here. So when it comes to me with SoFi, very strong growth company, like 40% plus type growth expected from this company over the next year. Market cap's obviously come down a lot. Very popular in the retail trader community. The tough thing with SoFi's stock price right now is SoFi, they're trying to figure out, is SoFi more of a fintech or is SoFi more of a bank, right? And so that's a tough thing with trying to value SoFi right now, is everybody's like trying to figure this out, right? Because banks, what do we know about banks? They're usually incredibly profitable, huge cash flows, very low growth. SoFi doesn't fit that. SoFi's high growth, not impressive as far as the bottom line numbers. Just not that company, right? At least right now. 5 years from now could be a different story, but right now they're not that company. And so that's a tough thing for me with the SoFi is I'm like, how do I value this stock? In my opinion, although they're seeming like they're getting more and more into the banking space, I feel like SoFi, I have to value this similar to like a PayPal or a Square stock. And so this is one I added to this watch list very recently. I'm going to do more work on this one. And don't be surprised if eventually I end up buying a SoFi, especially if the stock stays under $10 for a significant amount of time. And we're kind of going throughout the year, and I do some more research, and I find out something here. If you have a very strong bullish thesis and a great understanding of SoFi, feel free to, basically just leave me a comment in the comment section, or follow me on Instagram. Send me an Instagram DM or something like that. Or if you're in my private stock group and you're watching this, just send me a Discord DM. If you have a really strong insight on SoFi and a really strong bull thesis, always feel free to send me a DM if you're a big shareholder of that company, because this is one I'm still doing work on here. Next one up here is Eli Company. I'm very, very familiar with. Eli, has a huge branding in Callaway, but also they own Topgolf now, and that's why they've had a lot of dilution over the years because of that Topgolf acquisition mainly, and some other acquisitions they did, but mainly because of the Topgolf acquisition there. So, oh man, we're already on low battery. Oh boy, I'm gonna have to plug this baby in here. Okay. So between them owning, obviously Callaway, their massive golf brand, and then owning Topgolf, which Topgolf is just insanely busy and a fun place, and a place where people like to spend a lot of money all the time. I'm looking at this company from the perspective of it's actually a pretty cheap PE company. Topgolf is going to be an incredible long-term business model for Eli in the end, in my opinion. Price to sales ratio is not looking rich at all for this company, and I love Topgolf from the perspective of I watched this company even during Rona, how busy the locations were in the United States here, and I see them having huge expansion opportunities international over time, and in the United States. Just in Vegas here, for instance, I could see them having at least 2 more Topgolfs over time. The strip location is so busy, I can't even get into that most of the time. I could see them having a location in Henderson at some point, and one in Summerlin as well. So that's just my city, right? And so I look at this is Topgolf alone, that expansion opportunity there is crazy, and the cash flows that business is going to produce long term are just going to be amazing, in my opinion. And I will say with Topgolf, it's going to be tough to compete with because the capital expenditures you have to spend to build something like a Topgolf to be on that sort of level, the amount of employees you need to have, right? And that's going to be, that's one I would call it competitive moat there for the Topgolf business, is just that upfront capital to spend, tens of millions of dollars. If not, some of these locations could be approaching, like $100 million eventually over time, the more insane they go over time. So Callaway I'm looking at, I like this business model, profitable. I think it's going to be much more profitable in the future. Is it unrealistic for Topgolf or for Eli to double up their net income over the coming years? I don't think it's out of the realm of possibility at all, right? So Eli, keeping track of this one and could potentially buy that one. Stitch Fix, number 10 of these 21 stocks. Stitch Fix, their business model is going to be in a sweet spot over the coming years, in my opinion. Right now, their business model has been hurt by some of the iOS changes for Facebook advertising, Instagram advertising, things like that. I'm very confident that's hurt Stitch Fix in the short term. They'll get through that, right? They'll comp against that. Offices opening back up, the world getting back to normal over the next, let's call it year. That's in my opinion, a very good thing for Stitch Fix's business model. And so this is a company I look at with $2 billion plus of revenue coming in 22 and 4 million plus customers. I think the stock's just got hit way too hard, and it's been hit way too hard. That's my opinion on this. And is this a business model that will be profitable in 22? No, but I do expect them to be profitable in 23, which is very, very important. Next one up here, Palantir, number 11 to 21. This business model should be profitable in 22. So that is something to keep in mind, and actually much, much more profitable in 23 and moving in future years. I think it's going to be a cash flow machine over time. I think this business model is going to be beautiful, all right? And the way I look at Palantir is I think if you are the CEO or an executive of any major company, I don't think there's any way you cannot consider using Palantir, essentially. And so from that standpoint, how many business models can you really say that with? And Palantir is one of those companies, tremendous revenue growth, is the type of company that should be able to grow 20, I want to say, let's call it 20 to 30% a year for like the next 5+ years, essentially. I'm going to move this a little bit over here because that sun's really hitting my face right now. But that's kind of my opinion on that. So, Palantir, heavy retail stock. A lot of folks have been kind of devastated in this stock because a lot of folks got in this one between $18 and like $22, $24. So it's kind of had that devastation happen there. But I look at this and I'm just like, I think it's going to be a beautiful business model at the cross sections of artificial intelligence and data. And like I said, if you run a major Fortune 500 type company, I don't think there's any way you can run your company and not at least consider the possibility of getting Palantir for your business model. All right. Next one up here, Micron, one of the biggest memory chip companies in the entire world. Micron's tough for me because I feel like they're kind of in a commoditized industry. But what I will say is only really like two main competitors for them, Samsung and SK Hynix. And outside of that, there's not really any major competitors in their industry. And the need for more and more memory over time, whether we're talking NAND or DRAM, it just continues to increase and will continue to increase for as far as the eye can see, essentially. And so it's always been a tough one for me. Is I'm like, do I want to buy it? It's been a pretty good performer over time. Low PE. It always trades at a low PE because it's kind of labeled as a commoditized industry. Price to book of under 2 on this company right now. Price to sales of under 3 for it. About $100 billion market cap. And like I said, it's just a profit machine, cash flow machine. The main issue with Micron is, if we did go into any sort of scenario where, let's say, NVIDIA's business model really slowed in a big way, AMD, those sorts of companies, obviously MU would get hit in the short term and their profitability would erode quite fast. But it's hard not to see memory just continue to increase for years and years and years to go in the future. Upwork is the next one, number 13 of 21. Upwork's a stock I actually used to own. I don't own it anymore. I cashed out of my shares in 2021, essentially. And Upwork, obviously its stock prices has gotten damaged recently over the past several months, but Upwork's a huge player in the freelance economy, the biggest player. They're actually a bigger player in that market than Fiverr. And price to sales ratio on about 5.6 on this company right now. I do expect Upwork to be profitable in 23. I want to be very clear about that. 22, I think, is a question mark. But if you're thinking about a company that just has unlimited growth for such a long time in the freelance economy, it's just going to get bigger and bigger. Sam, I really like Sam. They obviously own their Boston beer brands, right? Sam Adams and Oktoberfest and Winterfest and all those different seasonal brands there. They also own other, I would call it more niche brands that are still known. Like if you're a beer drinker, you're going to look into the company, you're going to see a lot of brands that you probably are familiar with. And they also own Truly as well, which is huge in the hard seltzer space. And so I look at Boston Beer Company as just a stock that's been a little too devastated now. It's trading at $300-something a share. And the PE ratio is going to normalize. They should get back to nice profitability. This is just a company that had a very bad 2021. That was a year to forget. That was let's call it the blackout year for Sam. That's just a year to forget. They did a bad job. But if you look at this company over time, I think it's important not to just judge them off of one bad year, because this is a company that's done an amazing job running this business for the last decade plus. And but they had a disaster of a year last year, and that's why their stock price fell so heavily. I do not expect that to continue. I expect their management team to get this business back on the right track to nice profitability again. And I think they're in a pretty sweet spot. So I'm gonna potentially buy that one here in 22. UPS, UPS is a stock I keep on this watch list mainly because I think about it as, if I'm looking for a place to park my money outside of cash, UPS is a pretty good company for that. Also a dividend play. I could potentially buy UPS. They have two main competitors. Amazon competes with them and will compete with them more in the future, but Amazon's really focused on their business rather than necessarily competing on a lot of the products UPS competes against. And they have FedEx, right? Outside of those two, there's really no major competitive threats to a company like UPS. So I like this one as a dividend play, a long-term play, and if it falls in any significant manner, I could, if I'm looking for a place to park money, let's say a lot of my small cap stocks beast mode, right? Let's say Tattooed Chef and Honest and Planet, and all those stocks go up 50 to 100% over the next, 12 months. And then I'm looking and I'm like, okay, I've invested so heavily in those and I'm having trouble finding good deals. And let's say something like UPS is trading around the range it is right now. And I'm like, I don't really want to get more into small caps right now. Let me park my money somewhere in a dividend play. UPS could be that type of play, okay? Google, same exact thing for me. The only difference with Google is, when I look at Google, I think it has a lot more growth than something like UPS, but it doesn't pay the dividend. So that's the only trouble there. But Google's just a beast. Between Google search, between YouTube, obviously they own YouTube, Android, just a beast company. It's one of those companies you throw money in. It's like, how do you lose money over the next 5 years, right? Amazon, I got to say, I think Amazon's at a very attractive valuation now. PE ratio on this stock of under 50 now. Price to books dropped significantly over the last few years. Price to sales at 3.5. The stock price hasn't gone anywhere in over a year and a half, which is just ridiculous to think about. And so I absolutely love Amazon, and Amazon Web Services is just going to continue to grow. That's a profit beast for them. Their, e-commerce business is just going to get, I don't know when that business stops growing, but it's no time in this decade. And so from just the context of thinking like that, is this a company that's going to do $1 trillion plus of revenue in a few years from now? In my opinion, yes, they are. And so Amazon, it's easy money. That's just the bottom line. It's easy money. Next one up here, Cruisy Doozy. Cruisy Doozy has been a stock I've been in and out of in the past, and it's usually treated me very, very well when it comes to Cruisy Doozy. The problem with Cruise is, although they're an innovative company, they got a great management team there. They've just grown the business over the last 10, 15 years. The issue with Cruisy Doozy is they get so much of their business from Apple, and so I keep track of it, and I could potentially own it in the future if it got to interesting ranges, or I saw them working on some sort of product or new chip that Wall Street maybe hasn't calculated yet, which has happened in the past. Cat, number 19 to 21. Cat, this is another one I kind of look at like a UPS type play, where if I'm looking for somewhere to park money and it's not trading at a high valuation, I could potentially get in. Obviously, mining is strong and should continue to be strong for them. Commodities industry's on fire right now, no pun intended, and Caterpillar should thrive because of that. The issue I see with Cat, though, is, in the short term at least, is kind of the residential, or let's just call it even the commercial real estate business in China, and how much that hurts or helps Caterpillar. Big infrastructure spending bills should be coming more and more over the coming years for the United States, but then again, that's kind of been a play for a while now. So, but like I said, it's kind of like a UPS type play there, okay? Next one up here, Berkshire Hathaway. So Berkshire Hathaway, I actually bought this one and owned it for a bit. When I look at Berkshire Hathaway, another thing I think about is like parking money. If I'm looking to park money somewhere, that's why I keep it on this watch list. Am I going to buy Berkshire Hathaway right now? No, absolutely not. The valuation's obviously climbed quite a bit recently, and there's just way better places for my money right now. But this is one I keep track of and could potentially buy if we get into some sort of high flying market. Berkshire is usually a better place to hold rather than cash. Let's just call it that. Okay. In the switch number 21 of 21, this is a stock I was in a while back, and it's pretty much the highest it's ever been right now. The company's been doing well job of executing. A company that's out of Vegas, and I learned about by living in Vegas, literally, data center company, and they just continue to expand and expand. And this is one of those companies, not the most exciting growth story behind them, but is it going to be a company that continues to grow and grow over the coming years? In my opinion, absolutely, and get to very nice cash flows and profitability over time. So, yeah, Switch is definitely, want to keep track of and could potentially own in the future. Wow, that was a beast of a video, guys. 27-minute video. Hope you enjoyed today's video, as always. If you want to check out my stock picking checklist, that 15-part checklist, check out the pinned comment down there. Also, make sure you sign up for our newsletter for Hungry Bull. It's absolutely free to sign up for. Cole and Dieter write that every day, and they, spend all day just kind of bringing up the biggest things happening in the business community, stock community, crypto community, and things like that. It's pretty awesome. So definitely check out pinned comment for that as well. Much love and have a great day.